All right, so this is a journal entry for purchasing not your stock, but the stock of other corporations as an investment. You might be holding on to a lot of cash and think, if I'm holding on to it, I think the market's going to do okay. So I want to get a return on my investment, and so I'll invest in some equities. And so you need to come up with the entry for it. If it was purchasing our own stock, this journal entry would be completely different. It would be called treasury stock. This is not a treasury stock journal entry. This is for investment in other company stock. So this might be buying the stock of a privately held company or a publicly held company. Most likely a publicly held company if you're doing this, because you usually want to keep this pretty liquid. All right, so what is the entry here? Let's start with things we can touch. Well, cash is going out. We have to buy the stock or buy the ownership of the other companies with cash. So cash is going to get credited with $44,000. All right, cash is credited with $44,000. All right, so the next question is, okay, so we're going to have a credit. Cash is going out. All right, and it's going to be $44,000, right? $44,000. So the question is, what's the debit? Well, we're buying equity of other companies. Again, if it was our company, we wouldn't actually classify it as an asset. If we were going and buying back our shares, you'll have to look at treasury stock, the treasury stock journal entry. This one right here, this is us purchasing shares of other corporations. And so this is an investment. So we could call it stock investment. We could call it any number of things. I'm just going to call it investment. All right. So investment of $44,000. And this is an asset. All right. It's investment of this 44,000, right? And this is increasing our assets as the cash is decreasing in equal amount. So everything remains in balance in the equation. So that's how you do this journal entry. Again, treasury stock would be something different. Treasury stock impacts your owner's equity. When you're repurchasing your own shares, it impacts your own owner's equity, not your assets. But when you're always purchasing other corporations, other companies, as it says in the problem here, that's going to be done with assets. And so you're going to have an increase of investment and then a decrease of cash because you pay for these with cash.